On a Friday afternoon in August 2009, federal agents walked into the headquarters of Colonial Bank in Montgomery, Alabama. They didn't announce themselves. They moved quietly through the building, securing files, freezing systems, positioning themselves at every exit. Nobody was allowed to leave with anything. Employees watched from their desks. Some thought it was a routine inspection, some thought it was a misunderstanding. Nobody understood yet that the institution they had worked at for years, some of them for decades, was already dead. By the time they understood what was happening, it was already over. Colonial Bank had $25 billion in assets. It was one of the 25 largest banks in the United States. It had branches across 5 states. It had survived recessions, market crashes, and the early tremors of the 2008 financial crisis. It looked, from the outside, like a bank that was going to make it through. It wasn't, and the reason it wasn't had nothing to do with bad loans or market exposure or the kind of systemic risk that brought down Lehman Brothers. It had everything to do with one man, one mortgage company, and a fraud so simple it almost doesn't seem real. The man was Lee Farkas. The mortgage company was Taylor, Bean Whitaker. And what they did to Colonial Bank is one of the most straightforward financial crimes in American history. Here's how it started. Taylor, Bean Whitaker was founded in Ocala, Florida in 1982. By the mid-2000s, it had grown into one of the largest privately held mortgage companies in the United States. At its peak, it was originating billions of dollars in home loans every year, employing over 2,000 people, processing thousands of mortgages monthly, operating as a major player in the American housing market. Lee Farkas became chairman and took control of the company's direction. And for a while, the business was legitimate. Taylor Bean would originate mortgage loans, package them, and sell them on to investors and larger institutions, including Colonial Bank, which had become one of their primary banking partners. It was a straightforward model, until the cash flow started to tighten. Mortgage companies live and die on timing. Loans go out, payments come back, but the gap between the two can create serious short-term pressure. Taylor Bean started experiencing that pressure in the early 2000s. And instead of addressing it through conventional means, cutting costs, finding investors, renegotiating terms, Farkas found a different solution. He started overdrawing Taylor Bean's accounts at Colonial Bank. Not by small amounts, by hundreds of millions of dollars. And to cover those overdrafts, he started moving fake mortgage assets onto Colonial's books, loans that didn't exist, borrowers who weren't real, collateral that had already been sold to someone else. He had a name for it internally. He called it Plan B. Plan B was not a temporary fix. It was the beginning of a machine that could never be switched off. Every fake asset created to cover one overdraft required another fake asset to maintain the illusion. Every shortfall plugged with invented loans created a larger shortfall that needed to be plugged next month. The fraud didn't just grow, it had to grow. Stopping it at any point would have immediately exposed everything that came before. So Farkas kept going. He recruited a small number of insiders at both Taylor Bean and Colonial Bank who understood what was happening and helped keep it hidden. Fake loan files were created, internal reports were manipulated, auditors were given numbers that didn't reflect reality, and because Taylor Bean was a large, active mortgage originator processing thousands of real loans alongside the fake ones, the fraudulent assets blended into the noise. By 2009, Farkas had manufactured approximately $2.9 billion in fictitious mortgage loans. Colonial Bank had been carrying them on its books as real assets for years. And here's what makes the timing so significant. This was 2009. The financial crisis was at its most destructive. Banks were failing across America. The FDIC was overwhelmed. Regulators were stretched across dozens of simultaneous emergencies. Auditors were under impossible pressure. The entire system was in triage mode. which meant that a fraud operating at a single large regional bank, buried inside a high-volume mortgage operation, was exactly the kind of thing that could slip through. The crisis didn't create the fraud, but it gave it the perfect environment to survive longer than it ever should have. There was one moment when it almost unraveled entirely. In 2008, Taylor, Bean, and Whitaker applied to participate in the federal TARP program, the Troubled Asset Relief Program, set up to stabilize struggling financial institutions. As part of the application process, regulators began scrutinizing Colonial Bank's books more carefully than they ever had before. They found irregularities. Questions were raised. The TARP application was quietly rejected. Farkas knew the window was closing, but he kept the machine running anyway, because at that point, there was nothing else he could do. Stopping meant exposure. Continuing meant buying time. He chose time. It ran out on a Friday afternoon in August 2009. When the FDIC took over Colonial Bank that night, they found an institution that looked solvent on paper and was hollow underneath. $25 billion in stated assets. A fraction of that in reality. The cost to the FDIC Deposit Insurance Fund came to $2.8 billion, the largest single payout in the agency's history at that point. Colonial Bank was gone. Taylor, Bean, and Whitaker collapsed the same week. The shutdown was immediate and without warning. Over 2,000 employees arrived at work one morning and found the doors locked and the company finished. No severance, no transition, just over. But the employees weren't the only ones who suffered. Taylor, Bean had thousands of mortgage loans in various stages of processing when the company collapsed. Homebuyers who were days away from closing on their homes suddenly found their loans frozen. Some managed to find alternative lenders in time. Many didn't. Closings fell through. Purchase contracts expired. People who had sold their previous homes to fund a new purchase found themselves without either property. Some lost deposits. Some lost years of savings. Some never recovered the ground they lost. These weren't Wall Street investors or sophisticated financial players. These were ordinary people who had done everything right, saved their money, found their home, secured their financing, and had their lives disrupted by a fraud they had no idea existed. Lee Farkas was arrested in June 2010. Federal prosecutors built a case that took nearly a year to assemble, but was, at its core, remarkably simple to explain to a jury. This wasn't complex financial engineering. It wasn't derivatives or synthetic instruments or any of the sophisticated machinery that made other financial frauds so difficult to prosecute. It was a man who had been writing fake loans, moving fake money, and lying about it for the better part of a decade. The trial lasted 2 weeks. Prosecutors called former Taylor, Bean executives who had participated in the scheme and turned government witnesses. They walked the jury through the mechanics of how the fake assets were created, how the overdrafts were concealed, how the fraud scaled from millions to billions over the course of several years. Farkas took the stand in his own defense. His argument was that Taylor, Bean was a legitimate business that had been destroyed by the financial crisis, that the company was a victim of market forces, not a criminal enterprise, that the losses were real, but the intent was not fraudulent. The jury deliberated for less than 2 days. They convicted him on all 14 counts of fraud and conspiracy. At sentencing, the judge noted the breadth of the damage, not just the $2.8 billion cost to the FDIC, not just the destruction of a major regional bank, but the thousands of ordinary people whose mortgages, jobs, and financial stability had been collateral damage in a fraud they never saw coming. Lee Farkas was sentenced to 30 years in federal prison. Several of his co-conspirators, executives at Taylor, Bean and at Colonial Bank, received shorter sentences in exchange for their cooperation. The insider at Colonial Bank who had helped facilitate the overdraft scheme pleaded guilty and cooperated with prosecutors from the beginning. What makes the Colonial Bank story worth sitting with isn't just the scale. It's the simplicity. Farkas didn't need complexity. He needed access. He needed a small number of people willing to look the other way. He needed regulators who were overwhelmed and auditors who were stretched. And he needed time, which the financial crisis, almost accidentally, gave him. There's a lesson here that goes beyond banking. Fraud rarely looks like fraud from the inside. It looks like a cash flow problem being managed. It looks like a temporary measure that will be unwound once conditions improve. It looks like Plan B. And by the time it looks like fraud, by the time the federal agents are moving quietly through the building, securing the files, positioning themselves at every exit, the money has been gone for years. The doors of Colonial Bank were locked that Monday morning. Employees stood outside on the pavement, phones going unanswered, the FDIC seal on the glass. $25 billion in assets. Gone. Nobody had noticed. Until a Friday afternoon when the agents walked in and didn't let anyone leave. If you want to cover stories like this, the scripts, the hooks, the research process, everything is at the link in the description. And if this is the kind of story you want more of, subscribe. New corporate collapse every week.